In 2012, it was revealed that several major banks had manipulated the London Interbank Offered Rate, a benchmark interest rate used to set the prices of financial instruments worth trillions of dollars. The LIBOR incident was a huge financial scandal with far-reaching ramifications for the banks involved and the whole financial industry. In this video, we'll take a closer look at the LIBOR incident, including its origins, consequences for the institutions involved and others. So let's begin the video. What is LIBOR? It's critical to understand LIBOR and its function in the global financial system before delving into the LIBOR scandal. The London Interbank Offered Rate is a benchmark interest rate used to determine the pricing of financial instruments such as mortgages, student loans, and financial derivatives. LIBOR is determined using the interest rates at which banks lend to each other and serves as a benchmark for determining the interest rates on these financial instruments. LIBOR is an important component of the global financial system, affecting the borrowing costs of businesses and consumers around the world. Because of this, it's critical that the LIBOR rate is set fairly and accurately. What is the LIBOR scandal? The LIBOR scandal was a well-publicized scheme in which bankers from several large financial institutions cooperated to manipulate the London Interbank Offered Rate. The incident created skepticism in the financial industry and resulted in an array of consequences, lawsuits, and regulatory actions. Although the scandal emerged in 2012, there is evidence that the collaboration began as early as 2003. Many major financial organizations were involved in the scandal, including Deutsche Bank, Barclays, Citigroup, JP Morgan Chase, and the Royal Bank of Scotland. The investigation revealed that the banks submitted incorrect information regarding their borrowing costs in order to manipulate the LIBOR rate. This allowed banks to profit from trades involving artificially low or high LIBOR rates. The investigation also found that the banks have collaborated together to manipulate the LIBOR rate. The LIBOR scandal caused a significant blow to the reputation of the banks involved, as well as the larger financial industry. It called into question the integrity of the benchmark-setting process and highlighted worries about financial companies' ethical behavior. The consequences of the LIBOR scandal. The LIBOR scandal had serious legal consequences for the banks involved. Barclays was the first bank to settle with authorities in the United States and the United Kingdom, agreeing to pay a $450 million fine. In agreements with regulators, UBS and Royal Bank of Scotland also agreed to pay fines totaling $1.5 billion and $612 million, respectively. In addition to facing monetary fines, a number of people faced criminal charges in relation to the LIBOR scandal. For instance, Tom Hayes, a former trader at Citigroup and UBS, received a 14-year prison sentence in 2015 for his involvement in LIBOR rate manipulation. The financial sector and investor confidence were more severely impacted by the LIBOR affair. The stock market fell after it was discovered that big banks had been manipulating a crucial benchmark rate, which shook investor confidence. The controversy has also brought increased attention to the need for greater control and supervision of the financial sector. The role of cultural factors in the LIBOR scandal. The LIBOR scandal did not occur in a vacuum, and it was not the result of a few bad actors. Instead, the scandal was a product of the banking industry's culture prior to the crisis. Prior to the 2008 financial crisis, there was a focus on short-term profits and a belief that the financial system was inherently stable. This culture of greed and short-term thinking could have influenced the activities of the banks engaged in the LIBOR scam. The LIBOR crisis also demonstrates the hazards of groupthink and a lack of responsibility in the banking sector. The banks involved had conspired to manipulate the LIBOR rate, according to the investigation of the LIBOR scam. This implies that there were no opposing voices or actions taken to stop the bank's unethical actions. The aftermath of the LIBOR scandal. Following the LIBOR incident, authorities and lawmakers have taken steps to strengthen the benchmark-setting process and restore investor trust. The creation of the Financial Conduct Authority's new benchmark-setting code of conduct is one of the major changes. The code, which became operative in 2013, establishes guidelines for how benchmark-setting procedures should be carried out and requires benchmark administrators to be transparent and independent. In addition to the FCA's code of conduct, further measures have been taken to improve the integrity of the benchmarking process. For example, the International Organization of Securities Commissions has established financial benchmarking principles, and the European Union has introduced the benchmarks regulation, which strives to increase benchmark transparency and integrity. The LIBOR scandal in context. The LIBOR scandal was not the only financial scandal of its time, and it was not the only scandal to involve unethical behavior by financial institutions. The Madoff investment scandal and the Enron scandal are two more prominent financial scandals from the early 21st century. Similar to the LIBOR scandal, these two incidents featured the use of fraudulent or illegal strategies to trick investors and increase earnings. However, the LIBOR scandal special, yes, it was a manipulation of a benchmark interest rate, which had major consequences for the global financial system. Finally, the LIBOR incident was a huge financial scandal with far-reaching consequences for the banks involved and the whole financial industry. This incident demonstrates the value of ethical behavior and responsibility in the financial industry, the necessity of strong regulation and oversight, and the importance of diversity and dissenting voices in preventing financial scandals. By learning from past failures, we may seek to develop a more transparent and accountable financial system in the future. Thanks for tuning in to another eye-opening episode on capital crimes, where we uncover the truth behind the dollars and cents. Before you go, fam, remember this: knowledge is power and action is key. If you're as passionate about uncovering financial wrongdoing as we are, then don't forget to drop a comment below with your thoughts, smash that subscribe button, and share this video with the squad. Together, let's keep exposing the dark side of the financial world and keep chasing the truth.